JP,
How
thanks
you
for
doing,
coming
David?
in, man.
Thank you.
A lot of questions. Everyone, taxes just ended not too long ago. You did an awesome little event over at ARIA. Intrigued us all with different things with taxes and misconceptions, things you can and shouldn't be doing, retirement, financial planning. So introduce yourself. Who are you? What do you do?
My name is Justin Poore. I am a financial planner and tax accountant. I've been in business for 25 years. Didn't necessarily want to be an accountant, of all things. I went to school for accounting, and after everything being so hard in accounting, I didn't want to be an accountant.
Yeah.
And I really loved money, so I figured, hey, maybe I'll be financial advisor.
Yeah.
So I went and got a bunch of licenses and started helping people with saving and whatnot. Then next thing you know, I went and got my MBA and another accounting degree and organizational management and leadership attached to that as well. And next thing you know, I started teaching accounting. And so for the University of Phoenix. So I've taught...
And you're busy.
Yeah, so done a lot of accounting stuff for not wanting to be an accountant.
Yeah.
But I was a city finance director for 8 months in my tenure. Substitute taught for 14 years, and obviously was an adjunct professor for the University of Phoenix for 5, and still just now working on running my business and enjoying my professional, I guess you could say professional hobbies, like being a Santa Claus.
I was going to ask you that. I was like, wait, you're not done. You're not done. You got some other things in there.
Yeah, I have my career and I have my professions, you know. So I'm a professional Santa Claus. And I also am a professional golf instructor as well with the PGA. So I have my little ancillary things that keeps me smiling away from having to crunch numbers and sit in front of a monitor all day long.
Yeah. And I don't know anything about golf, but when you and the guys were talking that day about golf, you got some pretty impressive numbers.
Yeah.
They were like, this guy can golf.
Yeah. I'm
I don't know the numbers, but
I'm a +1 handicap, and that usually means that I have to add a stroke more, whereas most people are negative handicaps, which means that they take away their strokes to get you back to par.
Gotcha.
And so
when I hear handicap, I'm thinking this guy's not very good.
Right.
Or what does that mean?
Yeah.
But they were like, oh, this guy can play some golf.
This guy can play some golf. Yeah. So most of the people you see on TV, they're all like +8s.
Gotcha.
+7s, things like that. You know, I'm like a +1. So
Got it. Okay, that makes that makes more sense now. Because that day I was like, he doesn't sound very good. Those numbers are kind of low. Aren't like the 8s and 9s a little better?
Right.
But that's hilarious. I was like, man, this guy can golf. He's professional Santa, and he's going to help us with our taxes today. Like, man, what are we doing?
Right.
Yeah.
So I kind of cover a lot in my life.
Yeah.
But it's fun. I enjoy every moment of it. And it's just
you got to enjoy
being
numbers.
able to help people.
Yeah,
really.
You got to enjoy numbers and enjoy people to have all those letters on your business card for sure.
You. Yeah.
Yeah. So first, I want to ask, because one of my favorite topics that day was tax deductions, misconceptions, some of your favorite tax deductions, especially for entrepreneurs, 1099 employees.
Yeah.
So we'll start with, what are some of your favorite tax deductions, or just deductions that people don't realize that they're not taking advantage of as entrepreneurs?
Yeah, most of my 1099 and self-employed individuals and corporations, what they fail to realize is how much they can deduct. And I mean, that's pretty much everything. There's 5 things I tell people I don't want to see. One's going to be pets. 2 is going to be groceries. 3 is going to be healthcare. 4 is any kind of personal items that you're going, like clothing. Or, that's really hard to deduct. And then the 5th thing is loan repayments. Most people think, well, I'm paying the loan, I get the deduction of the loan payment itself. No, it's just the interest. So there's a lot of misconceptions with what you can deduct versus what is eligible to be deducted. But I explain that when you, especially for self-employed individuals, typically you might not be the only self-employed individual in your household. And so you might have a husband or spouse or wife or significant other of some sort that you take out to dinner. Well, make that a business dinner.
Yeah, yeah.
You know what
exactly.
I mean? You go and get Starbucks for the team, that's a deduction.
Yeah.
So a lot of
Yeah,
people
spend a little bit
of
yeah.
money.
Take a past client with you or something, in case the IRS starts snooping around.
Exactly. And they allow you to give gifts to clients and whatnot. And my mom was a big Yankee Candle fan, so she would go and buy up a whole bunch of candles, and nobody knew that she kept 5 or 6.
Yeah, exactly. Yeah.
But that's a deduction.
I definitely don't do that. All my snacks and protein bars, those are for the cops. Those aren't for those are for my clients.
Yeah. So I mean, a lot of people miss out on realizing how much more they can deduct when they have that business use purpose and the process behind it.
Yeah.
So being able to pick out, and meals is one of the biggest thing that they say, oh, well, I just had lunch here or there, and people leave tips and it's cash.
Yeah.
Well, because you left that cash tip, you're not recording that somewhere. And that's a deduction that people are missing.
Yeah.
That you're giving away money, and that's deductible money that you otherwise could be picking up.
Got it. So just to be clear, so if I am out somewhere and I'm having just eating by myself and I'm a 1099 employee, can I write off my meals, personal meals, or does it have to be with a client, a business meeting, or how does that work?
Ideally, it's with someone, or you have a business purpose. Now, there's travel meals, and that's where we get into like per diem. Whereas the IRS allows up to almost $65 a day for your meal allowance.
Yeah.
So
it's not 100% write-off every time you go to eat food.
Right.
Got it.
But I mean, if you pay attention to the per diem rules and the rates, you get $65 times around 200 days of working days. You multiply that out, you can have a $12,000, $13,000, $14,000 deduction.
Especially when you're living in the valley and traveling, and you're hitting Visalia, Tulare, you're meeting with people all the time. It's like, all right, time to eat some lunch. Why don't you come with me? I'll buy you lunch too, and then just make sure you save those receipts, because I don't think they're playing around anymore.
No, they're following you. They're following you, and to that point, here in the Central Valley, we have a lot of driving. And so leaving your office could be a 10-mile drive to lunch, and then it's 10 miles back. So there's 20 miles that can be accounted for into your day. That is a deductible expense.
Yeah.
So I tell people, hey, and even the IRS says, we want to see you have an oil change at the beginning of the year, and if anything at the end of the year. So that way whether it's December or early January, somewhere in those 2 months, you have an odometer reading beginning and an odometer reading end.
Yeah.
And then somewhere in between there, we can recreate where you went, how you went. Most people keep a mileage log.
I learned to have an app.
An app is amazing.
The app I use, it just, as soon as I start driving, And because a couple years ago, I got in a little trouble, and I didn't record things correctly, and I couldn't find receipts, and my odometer, my EA at the time was like, I wouldn't do it this year. In 5 years, they're gonna go, hold on, what is all this? This is not, we bought a new car that year, I was doing it wrong.
Right.
So I was like, man, what a waste, because I did a lot of driving that year. And I was like, wow, that could have been at least a couple thousand in deductions for me, complete waste.
Yeah.
So it's always better to have some type of app or something I've learned. Yeah. And then still, I actually have the app I use takes a picture of the receipt, because they get, they sit in the sun and at the end of the year, it's just paper. There's nothing there. So, I've heard from other people that might not be good either, because if they do an audit on you and you got just boxes of receipts, they're gone. Basically, the paper's gone.
They're gone.
So
always keep a digital copy. And I do tell people, whether you keep your receipt or you don't, you have the transaction recorded somewhere on a bank statement, a credit card statement, something. If you're into an audit, spend the extra minute to go through your statements and highlight, and go to a calendar and recognize, okay, I spent it on this day. This is why. Have justifiable reasons. Yeah,
that 30 seconds will save you headache in December, November.
Yeah.
I've learned that. Yeah. No, so one thing I did do a couple years ago, I finally got smart, went to the bank, and I got just a business credit card. it's just its own, because I was using my debit card and I was doing this card and sometimes I'd use this, and my EA was like, you need to just get one card for all of your business and it will be so much easier on you. Yeah. And if they do audit you or you lose a box of receipts, you have everything printed out and everything is in one, and you won't get hacked.
Exactly.
So if
you do get hacked, it's easy to fix.
Yeah, and I did learn that it is a lot easier to get your money back from the credit card than your bank savings, and then it turns into a whole, the court, that whole thing, And so I did learn that credit cards are just the way to go, because they do not want anyone stealing their money.
Right.
So they're going to get you your money back a lot faster, and then they don't have access to your savings account. But at the end of the year, it's just all on one. All my Amazon stuff I'm buying, my business, orders, gas, and then I think last year I got like $800 back.
Yeah, it's a deal.
And I was like, oh, cool.
And most of them will give you an annual summary where they'll break down all the spending categories for you for the whole year. That makes my job a lot easier. Yeah. Because then it's like, okay, you brought in these details and you have this supporting details. I kind of match them up together. Accounting is really like putting puzzles together. Mm-hmm. You have all the pieces and they kind of spread them out, and then you got to build a picture. Yeah. And as long as, you can change colors, just as long as you get the picture done. Yeah.
Yeah. So, and I'm sure too, when I'm not organized, I've noticed that I pay a little more. Yeah. So that's a little thing that I learned. Okay, the more organized I am, because I have my set rate, with the accountant I used to be with, you have a set rate, but then the more stuff you send and they hourly have to go page through page. And I was like, whoa, why am I paying an extra $400 here? They're like, we spent another 6 hours trying to find out where this money was going, this credit card and this credit card, and we don't know what these notes mean. And I was like, oh, the more organized you are will save you money too.
Precisely. Yeah. Yeah.
Okay.
Realtors would bring me what I called the magic box.
The shoebox?
The shoebox, where it's all the receipts, and they say, lay them out. And I'm like, oh boy, we can't take some of these.
Yeah, my grandparents had the shoebox, and I was like, man, that's going to take a while to go through.
Yeah, and now we don't have, because of the digital nature and whatnot, most accountants are dying breeds. We don't, the average age in my field is 56. And so, I'm 45, and, I don't see a lot of younger people being, it's not a,
they're not jumping into the profession I want to do that.
This is not underwater basketball. So I think it's hard for a lot of people to really get into something like this with that misconception of what's going to happen in this career. It's long hours for little pay, and you get people complaining all the time, and then you got a government on top of you for that too. Yeah. So it's I
don't know how you do it.
Yeah, it's tough. Well, now you know why I do 5 other things. You know what I mean? It gets a little struggle bus. But it's interesting where people, the shoe boxes are starting to go away because of the technology that we have.
Makes it easier on you,
it a lot easier.
Teach people, hey, just do this. Make it easier on both of us.
Get your QuickBooks online. Yeah, something like that.
No, exactly. What? So those are some of the misconceptions. Real quick, I keep, there's all these conspiracies on TikTok and YouTube. What do you think about the 87,000 new agents that the IRS has hired? Because I think a lot of people don't realize that a lot of people are also retiring. Sure. But then they're still saying that, I know, but there's still a lot of agents not even replacing those people retiring, but doubling or tripling. What's your thought on all of that?
So it's an interesting thought with that, because for the 87,000 that were hired, we also have the Doge cut that came in the next administration that basically eliminated half of those, I'm sure, in some capacity. Yeah. A lot of that 87,000 weren't auditors. These are mailroom clerks. They are janitors. They are people who aren't even touching a computer. Yeah. So
they're just technically.
It's literally because IRS. I'm an IRS person. Yeah. They are the security guard, and they hired 15 of those, and that's part of the 87,000. Yeah. And I try to explain to people whether we have the IRS being the world's largest employer, or we eliminate the IRS altogether. At the end of the day, our computer systems now tell us what we owe and how much we owe and when we owe it.
Mm-hmm.
So the IRS is basically one big computer system now.
Yeah.
So when you submit your taxes, a human being's not sitting there looking at your return. It's going through a system, and only when that system flags something will a human being eventually get to you.
Got it.
And that could be a year, 2 years away. So whatever you think you're doing now, you could think that you're doing it correctly, and then next
Or think you're getting away with it. You're just in line.
And next year you get the letter, and you're like, "Shucks, I got a letter." And then
3 years ago.
Yeah, exactly.
Oh man, I do remember that. I thought I got away with that.
Yeah, and that happens that way.
Yeah.
It happens that way. So it's neat to think that we have 87,000 people that everyone can get all up in arms about. I'm going to get audited.
Mm-hmm.
The fact of
They're
the matter
coming
is
after
they're
us
not
hard.
they're not coming to get you.
Yeah.
They're not coming to get you. They're going to come and get you if you misspell things, if you have wrong numbers in different places, if you report things that you should not have reported or should have reported but didn't know, that the IRS knew.
Yeah.
You know, so one of the biggest things I tell people now, and especially in this age, is give yourself an opportunity to know what the IRS knows.
Got it.
And get yourself an online account with the IRS. You have to do the little ID me thing and all that other stuff.
Yeah, I just started doing that last year.
Right.
Yeah, I get little updates. Hey, you know, I haven't had to fix anything yet, but if there's something incorrect or something's a little spooky, or hey, this person has the same. That's what happened. It was like a name thing, and I had to just say, no, that's not me. I live in California.
You're right.
So
yeah,
I'm glad I did sign up for that. I got a little email called little number.
Yeah, and you can get an IRS PIN number for identity theft as well. It takes a little bit of extra time to get in there, and it's a hassle for me as a preparer. But it helps individuals save their identity. It helps you as an individual know what the IRS knows. And then it helps you see what your balances are. You can make payments directly to the IRS through that portal. The benefits for you to basically become accountable for your accountant is really helpful.
Yeah, exactly. Yeah, 'cause I always see, there's 87,000 new agents and all this debt and money we're giving away. They're not going to miss anything. They want to collect. And I'm like, 87? I'm like, that has to be everybody, though.
Sure.
That can't just be auditors.
That's everybody.
But then I did see, I kept reading the article, and I don't know if they usually buy that much ammo. And I was like, wait. IRS, they bought $3 million worth, or whatever number it was. Yeah. It was a lot of ammo. And then I did see a video of their IRS agents clearing buildings, and it was a mess. And I was like, wait. I was like, I didn't even know. Obviously, they might have to send people out.
Sure.
But the people that were armed, and then it breaks down how much money they spent on guns and training and ammo. And I was like, this just got interesting. I didn't even know they carried guns or had their own agents. I thought they would just call the police or FBI or whatever it might be. I didn't know they went raiding houses.
Yeah, for white collar crimes and everything. Yeah, they have they call it TIGTA, and it's the Treasury's version of the CIA, basically.
Yeah, I did not know that.
Yeah, and don't ever if you ever talk to an IRS agent. That's why I always ask: is there any IRS agents in the building? Because I don't want to.
Do they have to answer yes?
They have to say. Well, they don't have to.
Yeah.
It's not like prostitutes and cops.
Yeah. Yeah, I was gonna say, is it the same rule? Are you a cop, man?
Yeah, what are you doing?
Yeah.
But ideally, you kind of want to know because you don't want to offend them or threaten them in any way, because they are federal officers.
Yeah.
And if you threaten a federal officer, then you got TIGTA coming to see you, and they're knocking on your door, and they got badges and guns.
So that's where the IRS have the badges, the guns.
Right.
Okay, that makes
sense. So
sense.
they get serious all of a sudden. It's like saying bomb at the airport with the TSA agents.
Yeah, they have agents that have the guns. Yeah,
they're gonna take you over there.
Yeah,
yeah.
Okay.
So there's a lot of depth behind the IRS, which still is why people are scared, because if they don't put you in jail, they're going to put your accounts in jail.
Yeah.
And so
freeze your accounts, your assets. You can't sell any. Yeah, that's the scary.
And it's tough.
Yeah.
It's tough. So,
Yeah.
be compliant. That's all we ask you to do.
Yeah, those articles got me because, you know, 87,000 and all this stuff and all the guns and ammo. And then they show the video of them training and these people are like dropping their guns. And I was cracking up, but I was like, wait a minute. But, you know, those damn articles, they always get me.
Yeah.
You know, and then it's like, well, okay, is it that bad? But that actually makes sense.
Yeah. And they're going after drug dealers.
Yeah.
They're going after, you know, white-collar criminals and money laundering. There's a lot of bank thefts and things like that. They go after them.
Got it.
So, you know, what you see on TV with CIA, FBI, and all that other stuff, they're working, you know, real crime stuff. Whereas when it comes to paper and all that other, you know, white-collar money laundering, things like that, especially in a crypto world now, that's where the IRS comes in and they're going to hammer people.
Yeah.
You know. And that's how the mafia basically got taken, is that they didn't pay their taxes.
Yeah. You know? Yeah, I know. I was like, man, they were going too. And then when I read that, a lot of it came down to taxes.
That's it.
And then it let the legal system come in a little bit, dig a little harder in the warrants. And I was like, wow, the taxes are what got them out of everything. Yeah. What with the deductions, I have to ask, if I have a very large dog, and I want to make him a tax deduction, is there a legal way to do that?
The most legal way you can do that is obviously have it set up as a service animal of some sort. Emotional service animals do not count. You need to have them as some version of like a security trained or organized therapy dog.
Got it.
Is medical necessity of some sort.
Yeah.
Emotional service dogs, they don't count. They can still count for maybe medical.
Yeah.
But if you want to take you can't have a Chihuahua be your security guard. You know, you got to have a working class dog. And if you do have a business, if you're just a W-2 worker, they're not going to like you. Yeah. But if you have a business and like you live in maybe a difficult place to live,
you work downtown. You work behind a gated building, or you're a
bring
truck
the Rottweiler
driver
with you. You know, then you have decent enough substantiation to say, hey, look, this is a working dog.
Yeah.
This protecting me.
I transport money at night.
Exactly.
You know, I got multiple trucks on my yard. This is my dog.
Yeah. And so now
security.
Yeah, now you have some legitimacy to it, and you can go forward with you know, and no matter what deduction you take, it's always questionable at the court side or the IRS side.
Yeah, that's why you want to have your ducks in a row like this.
So figure out everything you can to prove something.
Yeah.
Whatever it is. Yeah. And once you feel good enough in that proof, use it. Go for it. See what happens. The worst that can happen is they send you a letter. And then you got to send them another letter full of everything that you think is right. And then it's up to them to decide yes or no.
Got it.
And that's why they have a tax
You're not
court.
just going to jail, but
You're not going to jail.
You thought was
but
a deduction.
You have a chance.
Yeah.
You have a chance, so take your chance. And at the end of the day, if they say, hey, we don't like it, then okay, fine. What do I owe? Or they say, that's great. Move on.
Yeah, they just say, you know what, that doesn't count. The money, the dog, you know what, you don't get to write that off. You're not going to jail. You're not in trouble, but that doesn't count.
Much.
Or unless you send a letter back and you're like, hey, here's the proof, and they go, yeah, that's a service. That's security. That makes sense.
Exactly.
So then at that point, dog food, training, dog anything food, you buy
veterinary
the dog.
Bills. Yeah.
Wow.
You know, so and I try to tell people too, if you really want to have a security dog and all this other stuff, own a farm.
Got
a
it.
ranch.
Yeah.
Or, you know,
it probably wouldn't work for me at my office and my dog sitting over here. Okay.
It's a little tough for that, right? It's a little tough for that.
Yeah.
But otherwise...
I'm on the third floor in a nice building. They're like, why do you have a Rottweiler
Yeah, you got
here?
A security guard outside checking everybody in.
Yeah, if the place already has security, like, okay, that might not work.
Right. Yeah. But you know, go through having actual service dog training. You can do that yourself. Go through the systems online and everything, and then you can get the certificates and the whole nine yards. And that helps. You know, again, build your case. Yeah. Whatever you have, build your case. But you know, and be, you know, we live now in the world of common sense. Like, is that little chihuahua gonna help you?
Yeah.
You know, I mean, they bite. I know,
Yeah.
but not like
You're walking 30 feet to your
nobody's
car,
getting
and they're
scared of that
going,
thing,
this isn't
you
a
know?
bad side of town. There's no,
Yeah.
You're not behind barred windows. Like, security cameras will be fine.
Right.
Have insurance.
And to that note, I get asked a lot about home protection, like guns, ammunition, things like that. And I explain to people to, again, have some business use for it. Like I have some air traffic controllers, and they're feeling like, hey, I need to have protection because of my status of being where I work and things of that nature. So have your reasons and create those, substantiate those reasons for these things. And then get your deductions. And they may not be federally deductible, but they can translate over into maybe the state that you live in.
Got it. Yeah, I have a buddy. Part of his business is on his property. He lives out in the country, and I don't know if his dog is a tax deduction, but I know it is. He sent it somewhere, and it's a trained dog. Like if he gets hurt or ran over or shot, the dog will literally like grab him and like drag him to safety, and it'll attack people. It'll put pressure on him if he's bleeding out. I was like, wow, I want a dog like that.
Yeah.
But he has trucks, he does transportation.
Sure.
He was like, I've had people follow me. I don't really know who they are. Some of our goods are pretty valuable. And so he's like, so I do have my two dogs, but one hangs out at the house. And then the other one that's not great with kids, that's just more my protection. He's like a lion over his owner.
Yeah.
He stays with me in the car and stays on the other side of the house.
So
and
like
I was like, man, I wonder if he's getting the deductions out of that
right.
dog.
I bet he does.
I mean, the training was like 15, 20 grand,
Oh, yeah, I bet. Well, and thinking of that comes with two different spots, like sports hunting. You have dogs that'll go out and chase the ducks down and all that other stuff. I mean, that if you are hunting competitively, now you have expenses related to something that you could potentially
just use common sense.
The other thing is maybe you want to create a Instagram or a social media following for your animal, and now you have a business of creating content with your animal. Well, the animal's got to stay alive. Well, maybe there's a deduction related to within the process of keeping this animal healthy and all that other kind of stuff. So there's little ways you can tweak things to put them in your favor. And again,
better just to call you and ask first before you start writing all this stuff off and buying all this stuff.
Right.
Because you're going to go, not really.
Yeah, you'd be surprised. I get all the P&Ls that have negative 100,000. And I'm like, well, you really actually made 20,000. They're like, how did that work? And I'm like, well, you can't take this, you can't take that, you could not this and not that.
Yeah, because you have to sign off on it, correct? Don't accountants before everything goes through? You guys have to say everything here is legal and justified and ethical, and then you sign off. So if you push all that through, you can kind of get in trouble too, right?
Yeah. My goal is, the idea behind any accountant is that we are representing the information the taxpayer provided us within the scope of the law in a reasonable and assured fashion. And
they're putting you in front of the government first.
We're the shield, right? And we're going to help keep all the shrapnel from hitting everybody. And so when the letters come, I get the phone calls and I say, okay, these are the steps we got to go through to answer this or that, or these are the things we need to finalize what they're looking for. And typically one of the biggest letters is usually getting a receipt from, my refund changed. Why did it change? Well, the taxpayer didn't get that interest statement from this one brokerage account, or this small W-2 job that I had 5 years ago, the 401k finally cashed out and sent me the money, and I didn't realize there was a form attached to it.
Got it.
Sometimes simple things of like, what do you call those lawsuits, class action lawsuits. Sometimes they pay us W-2s. Well, they come with the check. And they don't come later. Most people throw those away. So that gets reported to the IRS. And so
because they didn't claim it or threw it away.
And
they're saying, hey, I gave that to him as my deduction, but they're saying, well, he didn't claim it, little stuff like that.
Precisely.
Okay.
So you'll get accuracy letters
Got it.
Oh, we didn't get this.
It's not always
so
scary. They're
it's
just
not
saying,
always
hey,
scary.
we need to, do you have this or not?
Precisely.
If not, that's not a deduction then, or doesn't count. Or,
Exactly.
Yeah.
Yeah. So
Okay.
when it comes to and again, that helps with having that online account, because now you can see what the IRS has reported for you.
Yeah.
Typically, in any given year, that doesn't allow you don't see what happened for last year until October. So because it takes the IRS time to upload everything.
Yeah. But they will find it.
They're going to find it. They're like the bank. You know, they're always right, one way, shape, form, or another.
Yeah, unless you can prove it. Yeah, no, I've messed up when I was a little bit younger. People would pay me for sport training on the side, and if it's over a certain amount, you have to claim it, and I would just cash it, and I cashed it, and a year later, I'm like, oh wait, I had to do what? They're like, no, you have to claim that, and I'd get a little letter, and I'd ask my mom, what is it? They're like, they paid you over $1,000. I mean, you have to report that, and they're sending that they
1099s.
Yeah, they're 1099. I was like, oh man, I didn't know I had to do that.
You learn the hard way.
I just thought I'd cash it. Yeah. What are some of the things where entrepreneurs, 1099 employees are dropping the ball when it comes to if they should be becoming an S Corp or a C Corp? Because not only do they want to have their Medicare and other things set up, but where I know that there's tax advantages there too, especially for retirement.
Yeah.
Where would you say, how would you tell an entrepreneur to set things up if you're talking to an insurance broker, a realtor, or anyone else that was 1099?
Yeah, so I usually set thresholds of what do you think your general income is going to look like. If it's going to be $50,000 and less dollars a year of annual revenue, then there's really no need to be an S corporation, C corporation, LLC, any of that stuff. You're going to be just fine doing the Schedule C self-employment tax reporting.
Yeah.
And a lot of that is because you're going to be able to take usual and customary deductions that will bring that income down. One thing that when you get above 50,000, and I think 50 to 75,000 is kind of like that very, purgatory-ish spot where you can decide what direction you want to
close, maybe make a plan.
But you get to 75 and above, the S Corp or an LLC significantly helps you. And you could do an LLC, file the forms to be taxed as an S corporation, or just go straight into an S Corp.
Because an S Corp is still, the taxes are going through to you. Through to you.
Yeah, but just in a corporate fashion.
Got it.
And so the S Corp, the LLC S Corp, what they want taxpayers to do is to pay yourself a reasonable salary.
Got it.
And so here's an example. You're a real estate agent. You sold enough homes to make $100,000 of net money, gross money. Okay. Now you're going to have all your net expenses to get you to a net income amount. And let's say that you're going to write off maybe 30, 40, let's say 40,000. So you have a $60,000 income now. Under the Schedule C, you're going to pay self-employment tax on 100% of that 60,000 plus your income tax.
Yeah.
Under an S Corp, what you do is you say, hey, I'm going to pay myself a reasonable salary from this $60,000. And the IRS dictates that 60% of that is what's considered a reasonable salary.
Okay.
So, somewhere, as long as you're above 50%, So let's say that you cut yourself a W-2 for $40,000. Now you're only paying self-employment tax and Medicare and everything on $40,000, not $60,000. The other 20 you get distributed, and that's normal income tax to you. So you're saving about 17, 18% from not paying self-employment tax on that $20,000.
Okay.
Now that's helpful.
So is that payroll?
That's payroll.
So an entrepreneur, I'm just 1099. I claim everything. I'm writing things off, but now I'm getting to like the $150,000, $200,000 income, and I go, I need to set something up now.
Yeah.
Because I don't have enough deductions at this point.
Precisely.
So that's when I set up an S Corp, and now I have payroll and I'm paying myself.
Correct.
And those things are coming out automatically, just like someone who's a W-2 employee.
Just like you're working.
Yeah.
Like you're
but
working.
some of that stuff's coming out for me, and now some of it's going towards my retirement, my Medicare,
Precisely.
and whatever else it is.
Yeah.
Okay, got it.
And that leads into being able to set yourself up with, retirement plans through your company. So you might, instead of having a SEP IRA, you can do a solo 401k. Or you might hire more people, and now you have a 401k plan.
Got it. Yeah, a lot of people think you have to, like, I've heard people say, well, I can't leave this job, my 401k's there. And I go, you can set up your own 401k. Like, you don't have to stay at this miserable job because of their 401k.
Exactly. So, well, the nice thing is, I mean, most people have miserable jobs that will match your 401k. Whereas when you're running your own business, you might not be matching your own 401k because it's your money.
Yeah, but if you're an entrepreneur and you're doing what you love and you're making $250,000 a year, then you can match. Yeah. It's good. The money's going to come out somewhere either way.
Precisely.
You have to pay taxes no matter where you go.
Exactly.
But it's funny when I hear that excuse, and I'm like, you can do what you love to do and set up your own thing, and then you can set up maybe a small mutual fund, you do some life insurance. Like, you don't have to stay here just because you have dental and a 401k.
Right.
Especially if you can make a lot more money doing this on your own.
Exactly.
But like you said, you just have to get things set up correctly, run your own payroll, and pay yourself accordingly so that you're not stuck with those taxes.
The best part of having your own payroll is, gosh darn, I'm going to retire. I'm going to fire myself, and I'll get unemployment for the next 6 months.
Can you do that legally?
Yes, you can. Yeah.
Oh my gosh.
Yeah, the state of California, our lovely EDD system, the Economic Development Department.
You're fired. Fine.
You're going to fire yourself because you have to put into the unemployment for yourself when you do the payroll. And so, sure enough, you're an employee of your company. So you can fire yourself.
Wow.
And then you go ahead and collect some unemployment for a little while.
So you're sitting there going, you're fired.
Yeah, you're all
unemployment
done.
Signed. Yeah. That's funny. I'm going on vacation.
We're all done with that.
Yeah, I'm done with you. That's hilarious.
Yeah.
So what other things besides the, if you're a 1099 employee, getting your S Corp set up, getting payroll set up, having some of those taxes come out automatically. You actually made me think. So technically, could I hire my kids who do my commercials?
Yes, you can.
Because my kids do my Facebook commercials. They do my Instagram. I mean, they bring me money at this point.
Yeah.
Literally, my son goes, Dad, I'll go, we should go to the park. We got to make some videos today. And he'll go, well, like afterward, do you think we can go get this? Because didn't you say these make money? And I'm like, wow, he's using his time against me now. He knows his time is valuable.
That's awesome.
I'll tell him, if we sell a few more policies this week, I'll buy those. I'll buy that skateboard,
Right.
But we got to go shoot these videos. And he's like, fine, we'll go shoot these videos, know.
Well, and that's a perfect example of another thing that most sole proprietors may miss. Is that, hey, I have kids. As long as they're not, as long as they can hold a pencil, they can be paid
or
something.
I have proof. Look I run YouTube ads.
They're doing this, they're doing that, And so
I pay for my ads. They're running. My kids are on them. They're the ones talking, not me.
Yep.
Yeah.
And so chances are you're not really even paying them, but on paper you are. Mm-hmm. And that's how you can get some deductions. And if you hire your kids, the coolest thing really is not only can you get the tax deduction, but now you're giving them income. Yeah. And because they have income, you can put that money into a Roth IRA for them. Mm-hmm. And you're the custodian because they're not 18, but you put that money into the Roth IRA for them. Now they have a tax-free retirement for the rest of their lives, while you're getting a tax deduction on it today.
Yeah.
And so what a great wealth transfer strategy that can be today.
And what a big leap in years that they have interest building up, rather than, starting, that at 25 or, whenever they get their real job.
30 for most people.
10 years old, by the time they're out of college, it's like you already have more retirement than most people have built up at 45, 50 years old because you got a 20-year jump on these people. And then makes me sleep easier at night because I don't know what retirement's going to look like in the future.
That's right.
I don't know how expensive things are going to be one day. I don't know if my kids are going to be able to afford, if colleges, the tuition keeps going up. Yeah, it's like, I don't know if anyone's going to be able to afford this, but with that Roth IRA, can they borrow from that for education purposes?
You're allowed to take $10,000 out penalty free for education purpose.
Okay. So they don't have to wait till 59 and a half to go back to college.
They don't have to wait till 59 and a half. Yeah, exactly.
Yeah. Okay.
So that's a big help too. And then any money that the parent put in minus any growth, that's always able to be taken out.
Yeah.
So there's carve-outs allowed for the money that's there. So when they need it, you can get it. And especially for the exemptions. So like you said, you set your kid up, they have something that is 10 years ahead of everybody else. Maybe even 20 years, because most people that I see getting into the workforce now, they're not even saving for retirement until they're 30 to 35.
Yeah.
And because they're struggling with the cost, they're either getting married or having kids or finding a house, or there's an excuse not to save.
Yeah.
And there used to be an excuse not to spend. Now that there's an excuse not to save.
Yeah.
And so I think if we can get people to kind of change that mindset back again, that there's an excuse not to spend, there's an excuse to save, you're going to start seeing people with some wealth again.
Yeah. Well, and I saw that huge mind shift during COVID.
Yeah.
A lot of people were exposed. A lot of my clients, the business owners, they were like, "Whoa,
yeah, how did
we
this
spend
change?
almost more than what we make, and we little too much vacation, a little buying too many trucks or equipment, and we don't really have 6 months a year saved up." And I'm going, why isn't your accountant calling you and going, "Hey, you guys got to slow down."
Right.
And COVID, I think that's when I started getting more phone calls. Hey, can we do some retirement stuff? Or, no 30-year-old wants to talk about retirement.
Sure.
But, it is like, hey, what are those things you're talking about all the time? How can I protect my business? Because COVID was scary. We saw people, just from stress, just heart attack, strokes, businesses going under, medical debt skyrocketing. And so I had a lot of people with interest in retirement, even though that's boring for a 35, 40-year-old to talk about. They're like, I don't even think about retirement right now.
Sure, yeah.
But the savings aspect was huge. A lot of people were just exposed, man. And then
Big
even
time.
themselves were like, okay, we got to revamp this a little bit. We got to put our money in the right places, if we're going to be put it somewhere.
Right, precisely.
Yeah. So with the kids, making your kids an employee to get them on payroll, is it 12,000 a year or
about that? Yeah.
Okay.
Up to 10. I usually tell people don't push the limit all the way up to the top.
Yeah.
You can. If you're
it's
making
like
all sorts of money, why not?
$800,000 a year you can pay your kid,
Yeah,
but
why
maybe just
not?
like pay him $500 a month
but
or
if
something.
500 to 1,000 a month, somewhere in that general world. Don't stress the system.
Yeah. Let's not push it and get one of those IRS letters.
Don't
And
need
then
the letters. Don't need the letters.
Okay.
Yeah.
So because I want to put my kids, could both my kids do my videos, so I can, pay both of them $500 a month. And even if, no matter how much I'm making that year, it is a deduction still to my income because it's going through payroll.
Correct.
So either I can pay that to the IRS because I'm like, I have no more write-offs. I can't keep buying stuff. I just got to pay this money. Or I can put my kids on payroll. The money I probably would have owed in taxes is going to them.
Yeah.
So it's all just, it's kind of like what Shaquille O'Neal does with his parents. I saw an interview where he's like, I got my mom on payroll, got my dad on
Everybody's
payroll.
not gonna
They
pay.
have their own houses. Their houses have offices.
Yep.
They both drive the Lambos with the Shaquille O'Neal. And I was like, either he can pay that money in taxes, or he can give it to somebody, or he has like his whole family on payroll. I think.
Exactly.
Yeah. So
And they, to some degree, the IRS prefers that because you might be eliminating income tax, but everyone is still paying self-employment tax.
Yeah.
And at the end of the day, all of that money goes into paying the Social Security benefits that are being paid today. So, sadly, in another 4 years from now, maybe 5, Social Security is bankrupt.
I saw that. And I don't know if it was another one of those articles.
No,
that
this
got
is
me,
the real deal.
But I saw like 2032 or 2035. It's like,
And it
how
keeps
does
coming down.
How does that work? What do you mean?
Right.
What do you mean we're running out? We're just, we have no more money.
No more money.
Sorry.
Yeah, and all the money that everybody is working and putting in is being sucked up by all the people who are retiring and not dying. So the faster we can
they're just living.
They're living a long time.
Yeah.
And they retire at 65.
Yeah.
And they live till 95. So there's 30 years, almost the same amount of working years they had. Now
people are living longer.
And things, and that's a good thing. We want people to stick around.
Yeah.
But the Social Security Administration does not want farming.
Somebody didn't budget that well 30, 40 years ago, though. Somebody didn't budget that well.
Yeah.
They're like, hey, you guys are all on your way out. Oh, wait, no, you're not. You're still sticking around.
Here.
And these kids are coming up, but they're staying in college longer. The debt is bigger. They're not getting into the workforce fast enough. So they're not paying into their Social Security until, my grandpa probably started working. Our grandparents probably started working a lot younger than we did.
Like 18, 19.
And now we're not even getting out of college until 25, 26, and that's where I think, I see a lot of these younger guys getting back into plumbing and ag and the blue collar stuff, that still pay $150,000 a year.
Pay a lot of money.
It's not like
And
they
we
don't
need
pay. Yeah, a lot of people are going towards electricians, and I was like, wow, there's going to be a huge shift here pretty soon. A lot of entrepreneurs, I think, too, that are just going to be scrambling because they're thinking, well, I don't have a check coming.
Right.
Which is where I want to get into the where I'm setting up a lot of people now is with the cash value life insurance plans.
Sure.
A lot of my buddies who do make a lot of money, even though it's not a tax deduction, well, unless they do like an executive bonus plan on their kid or something, or their spouse or whoever works for them in the family. But I'm setting up a lot of cash value plans. Some people are paying a couple $100 a month for their kids, and they want that money to triple by the time their kid is 60 and have that tax-free income, because they're thinking, when I'm gone one day, if the property tax keeps going up and everything keeps getting more expensive and there is no retirement and the 401ks, they go up and down and they take dips, and they're thinking, my kid has to have something else.
Right.
Maybe set up the Roth IRA, have a cash value policy that also protects them with living benefits. But there's just different ways. You gotta trickle a little money into each pot, because we cannot rely on retirement. We can't rely on the government.
You can't rely on it.
There's no one coming to save you. You gotta save yourself. But the younger you start, the better, and the less expensive it is, because you don't have to dump so much into it later in life. Do you see a lot of business owners not protecting themselves with life insurance?
100%. Yeah. Especially here in the Central Valley, we have a lot of land, and we have a lot of land owned by generational farmers. And
I see.
And these generational farmers now are getting to the point where their kids don't want to farm. Mm-hmm. Well, if you have, say, 4 or 5 kids, and all 4 or 5 of them do not want to farm your 1,000 acres that's worth over $10 million, you could have an estate problem. And
someone's got to pay that bill.
Somebody's going to pay that bill. And
people go, wait, I inherit this, I got to pay for it?
Right. Invariably, there's going to be one brother or sister that says, well, I don't want to lose the farm. I want to live in mom and dad's house, or whatever the case is.
You better start parceling this off.
Well, now these 2 people have to pay the other 3 people out for the value of what that is. There's no way anybody can have that amount of money unless they get life insurance. Yeah. There's just no way.
I've already had, just last month, we haven't put a plan together, but it looks like mom and dad, they inherited a big chunk of the farm from his family. Yeah. They invested, they grew over time, and they were in a good spot where they just kept buying more land, because the next guy was like 1,000 acres over. So they're like, hey, take them up. Let me buy this 100 acres, and it's kind of like, it's like Yellowstone all over. Yeah. They go to the bank, they get the loan, and they say, let me expand another 100 acres. Let me expand it. And now I got 4, 5, 6 kids and brother-in-laws. Everyone can come to work. But before you know it, now your net worth is pretty insane. Massive. The business has grown. You've got 40 trucks going with almonds in them, and you've got a factory, but you still are technically renting where you started. Yeah. And the property taxes are going up. And like you said, now the kids are getting into crypto, and they're getting into all these other things.
Yeah, they're making money every other way but farming.
And they're like, you know what? This makes money, but it has its up seasons and it has its down seasons. The employees, they kind of come and go. And I'm seeing that just as the parents get older, they're actually realizing, they're coming in, talking to an advisor and going, what should I be doing?
Well, what's happening?
And they go, we need to get this squared away quickly, because if God forbid, if dad was to be gone tomorrow, or mom, who are the main 2 people who know how to run this, what's that look like estate tax? Or, God forbid both you guys pass away. A lot of people, what is it, federal? Is that the estate?
The estate plan.
The estate is federal, correct? Like it's over 11 million. It changes all the time.
Yeah, it's about close to 15 now, I think.
Okay.
So,
yeah.
But it gets crossed fast. Yeah. Especially here in the Central Valley, when you're looking at $50,000 an acre parcels.
Yeah.
You know, I mean, that's a lot of money for 1 acre, and they're selling thousands of these things.
Well, and these people are worth a lot of money now.
Yeah.
So that's where I explained it, and they go, well, why would I need life insurance? I said, well, every dime that your net worth goes over, you know, that 11 or 15, whatever it is, which I'm like, you're at like $30 million, like your net worth.
You blew it.
Yeah. Like what is it? You have, what is it? 9 months?
Like 45% tax.
40% tax. So if you're worth, say it's 15 and the threshold is 15 million and you're worth 20, about 45% of that 5 million. So couple million there in estate taxes that are owed, and that has to be paid back in like a year or something.
Right now.
Yeah.
The IRS says right now.
Yeah.
You know, or else we're going to lien.
And people have not even farming.
No money. So they end up selling more land, creating more of a tax burden.
Yeah.
For more years, just to be able to satisfy. Ultimately,
and then when you sell that, you still owe tax on that too.
Yeah.
Right?
So ultimately, it's very sad. The generational farming is dying.
Yeah, but if you have life insurance, $2 million that says, hey, when I pass away, this bill is going to you now.
Right.
This is now your estate. You owe about 2 to 3 million. So I'll have people that get like a 4 or 5 million policy just for some cushion for the next 10, in case they live to 90 or whatever.
Right.
And things in their value and their net worth keeps going up. But I think a lot of people don't have a will, or they don't have a trust. Well, wills don't do much, but a trust, they don't have those couple $1 million to pay that bill.
Yeah.
And it just lands on the kids. And it's like, oh, figure it out.
So this is the only plug I'm going to give is Nationwide. Nationwide's on your side.
Yep.
Well, they have a whole nother division called Land as Your Legacy. And they will, through representatives like either yourself or I who are life licensed, especially those who are connected with Nationwide in some way, I am, you can work with an agent such as myself or you that will give you a full itemized accounting of what you should be doing, from estate planning to to everything.
So it's like a free financial plan.
All for free.
Gotcha.
And it's a big booklet. And most of my ranchers and farmers, that I bring the booklet, they look at me and they say, we're going to do this?
Yeah. They slide it over to their wives.
Like,
that's what they usually do in here. Usually when they come in here, they just kind of slide all the sign that, honey. I'm not doing that.
Yeah, we're not doing that. But when you get in front of folks and you actually start going through their family and the family dynamics and then what they really owe and what they really own, and then you look and see that, oh gosh, I didn't realize that 4 of my kids don't want anything to do with farming at all, or ranching or anything.
How are we going to split this up?
How are we going to split this up?
How do people not fight when I'm gone?
Exactly.
How do they not destroy what I put together?
Exactly.
Like a series of Yellowstone.
And I've dealt with a lot of clients here in the Central Valley who have been here since the early 1800s. And so you have these early 1800 people, family generations, and they're starting to realize that, gosh, come 2030, none of my children are going to be running this operation. They're going to sell the farm and let it go somewhere. And that's, you have a couple hundred years of generational farmers starting to actually not be generational farmers anymore. And that's wild, And a lot of that is because generationally they bought that land for $1. They may have
you're
just
gonna
planted
pay the
that
difference
flag,
on it when you sell
and now you're getting paid millions of dollars, and no one wants to keep it or work it or any of that other stuff. So it's really crazy to see, and that's where life insurance makes a big difference in not just the living benefits for the family, because invariably ranchers they don't die. We just suffer really long. They eat beans all their life. They're gonna live on morphine for 3 years.
Pretty much.
No big deal.
It's too tough to die, but too broke to live.
Exactly.
Yeah, that's what one of my clients told me. I was like, wow, you guys are really like those Yellowstone dudes. Like you just won't die, but I'm going broke. I'd be better off dead.
Yeah, that's exactly it. And so you can use part of those life insurance policies to cover while you're living.
Yep.
And that's the living benefit.
God, I'm preaching that all day over here.
And it is a more of a need now because we're seeing the older population need it more and more.
Yeah.
And at the end of the day, I don't think either of us want to wipe butt.
Nope.
So, you know, we have nurses and individuals who
That stuff gets pricey.
and that gets very pricey because they don't want to wipe butt either.
Yeah.
You know?
Yeah, if you're talking $5,000 to $8,000 for them, the private nurses at your house, or to you to be in a home, and a lot of construction companies I work with and farmers, they're like, I'm not putting my family. You know, they're very family oriented. They're, you know, you see a lot of these new houses, they have the mother-in-law suite, and there's 6-7 bedroom. I'm like, okay, there's something going on here. Somebody knows something.
Somebody's
because
taking care of somebody.
So all these houses now are, you know, they always have a section in the cul-de-sac that has the 7-bedroom house. I'm like, parents are going to be moving in with their kids pretty soon.
It's going to happen.
Yeah, they're going to have to combine their Social Security or something. And if they have heart attack, stroke, the cancer, you know, that can wipe most people out financially. So that's where that comes in, you know, but that could save you $8,000 a month having mom and dad. And I've seen it with my Hmong and my Indian clients. They are they make a plan for the parents to be there. They're like, I'm not putting my parents in a home. We need to financially structure this where their Social Security pays for their, you know, or whatever it is.
Everybody's pitching in those cultures.
Yeah. The different cultures are everyone has life insurance on them. You know, talking about life insurance with Indian, Hmong, Asian, I mean, they're like grandparents all have life insurance. Kids all have life insurance, and it just stays in that money pot. Yeah. You know, so even if they're small amounts, you know, they're just, they usually plan pretty well because they're very family oriented, and they're like, money just stays here. We're not putting them in a house and paying $12,000 a month for someone to wipe butt over there, pretty much, you know.
What would so you sell insurance to? What is your minimum death benefit that you encourage people to at least have?
I think the minimum for most people is about $500,000. I would say that $500,000 to $1 million policy is like really popular. You know, because once people they go $1 million. You know, and then once you start looking through things and your mortgage and how much income you have every year, how much your kids from 10 to 20 years old would need if you were gone, and then the spouse starts looking at them like, you're not leaving me with $10,000 a year to live on, you know. Right. We've got a 2, an 8, and a 12-year-old. No way. So I think once they look into those numbers, and then their mortgage, or you know, they're renting, but they would like a home later, and they're like, okay, here's enough money to buy a house later. Yeah. Well, how much are houses in this area? It's like $500,000-$600,000 for, you know, for a pool and all that. So that with their income, $500,000 to $1 million is like minimum. That's like the most. I mean, it goes from there up. Haven't sold a $200,000-$300,000 policy unless it's like a permanent policy. I haven't done a term policy that low in years.
Yeah. So you're doing a lot of term.
A lot of term, a lot of IULs. You know, the IULs are different. You know, with the some people want the cash value, some people want half and half. Yeah. But yeah, I mean, from $1 million to maybe $5-6 million, somewhere in there. I've only sold like a couple like $10-15 million policies. Those are a pain in the ass. Oh yeah. The pyramid and all this stuff.
They want to make sure that they're gonna live.
Yeah, you know, but I mean, if their net worth is there, they just have to prove it health wise. Right. But yeah, I would say that's like minimum 5. Those are really popular. 500,000 to like 2 million. Yeah. Those are pretty popular with just regular individuals, not even business owners. You know, the business owners usually need a little bit more, or somewhere in that range, but they do like a split of half permanent, half term, or maybe one drops off, or they want the cash value, you know, where they'll take a bunch out on their kids as well, type of thing. Right. Yeah. Because for you, I mean, you talk to business owners all the time. Where do your needs sit usually?
Yeah, I kind of look things a little differently in that I kind of look at more of what their current assets are and where they may be going, because nobody expects to die tomorrow. Yeah. Right. And so in order for me to try and give them a little bit more permanence, I don't really do a lot of term policies. I'm usually siphoning as much dollars into some version of a cash policy. Yeah. You know, an IUL specifically is usually very good. And I usually write a lot of $100,000 policies.
Do you do like increasing IULs type, or is it just
like return of premiums where the cash value is growing on top of the death benefits? So at least they know every dollar they're putting in is coming back to somebody. Yeah, no matter what.
Yeah, your car insurance doesn't do that. Car insurance doesn't. How much? Let's do the math. I put, you know, my health insurance, I put $50,000 into this over the last however many years. They're not giving me my money back if I didn't use it. Right. You know, like life insurance does.
Yeah. So I try and focus more on the permanent side. And only when we have that significant gap in coverage for if you do die tomorrow, then I'll look at the term policies.
Yeah.
And, that kind of gives, at least in my world, in my experiences, it gives people that foundation.
Yeah.
I have something permanent, and I have to pay into this permanent. It's a have to.
Yeah.
And then the other foundation is getting a Roth IRA. You have now a tax-free-ish item that protects everybody. Now you have a tax-free item that's available. And then I tell everybody, okay, that's just two legs of a stool. We're not sitting on you're not going to fall over.
Yeah.
So you need one more leg.
They're like, gosh, more?
Yeah, at least one more leg, and it's an easy leg.
Yeah.
I said, just have a savings account. A transfer on death account. I call it a daddy account. It says you got to call daddy and ask for money.
I was like, wait, where is this going? What's
You call it I call it the daddy account. So you're going to save your money. You got your life policies. You got your Roth IRAs for your retirement. What about all those other goals you have?
Yeah.
And just have a simple savings account. And a lot of people
actually put into
it. And a lot of people can't do that. That's why send it to me. And it's in a daddy account.
Can't touch it.
And when you need it, you got to call daddy.
Yep. Oh, I got it. So you're daddy.
I'm daddy.
Got
I'm
it.
Daddy Santa.
Oh my gosh. I was like, who's daddy though?
So even my own father, I have an account with him. He says, son, I want my last check to bounce. And I said, okay. And so, but every month he'll call me and he says, hey, daddy, I need some money.
Or he does it and you're like, say it. He's like, not saying it. Not saying it. Yeah. Oh my gosh, that is funny.
Yeah. So, but that's the key, is that you have to have, if you want to be accountable to yourself, have accountability partners.
Yep.
And
delete your damn Amazon.
Delete the Amazon. Hey, you got Starbucks. You can spend $20 a month easy. We'll put 25. Drink water.
Yeah.
Put 25 in your daddy account.
Or buy the damn $20 bag and make it at home and save yourself $150 a month.
Even some of the crazy people that I've seen to save money was buy the gift cards and then they load it on their their application and then they get rewards for it. And hey, whatever you're doing gives you some sort of reason to save something.
Yeah.
And if you keep those processes of saving, you're going to find yourself where, hey, I have extra money to spend any old time, any old way.
Yeah.
Whether you need it or you don't.
No, exactly. Yeah, that's why most of my clients, they like to put their insurance and all their stuff in the first of the month.
Yeah.
Because I have some business owners, they're paying $1,500 a month for their insurance. They need the big death benefit. They want the cash value. They've got their solo 401k, so they're like, okay, if I put all this first, then I won't go spending all the rest of this money, and then we, me and my wife, we both see that, okay, that came out. We have this much money to play with. Let's not go crazy. But it is interesting. So I was going to ask, I guess it all just depends on the client though. Yeah. Because I'm setting up my life insurance policy is different all the time.
Oh yeah.
Sometimes I'll do a blend where it's a younger family, construction company or whatever it might be, and they're mom and dad are making good money, or dad is and mom stays home because they've got 4 kids or whatever it is, and we'll do a half and half. We'll do $1 million 15-year term. And then, some like an IUL or a whole life on the side as well. So at least they're getting something back at the end of that. And then it's interesting. I actually had a guy the other day, health wasn't great, so he couldn't get that big of a policy on him. He could afford it. He just couldn't get a very big policy on him. So he maxed out his wife and his kids' cash value life insurance policies.
There you go.
And I go, technically, if something were to happen to you in the future, you are the owner of those policies. So you can tap into that cash value if you need to, and then put it back, or just let the kids have it one day.
Right.
And he was like, no one told me I could do that, because a bunch of people basically just denied him, and they were like, no, sorry, you can't do this. And I said, well, I got a few companies. Technically, as long as you guys have the same amount of coverage, let's get you this term policy. Let's max out the kids at this amount, at this much. Get their death benefit low. He wanted to put in a couple $100 though.
Yeah.
And their cash value was going to be, at 25, they're going to have quite a bit of cash value in there.
Yeah.
And he was like, so I can tap into that and reinvest into my business, or just let them have it if I don't need it. And then, on top of that, he has the living benefits,
zero cost loan provisions,
zero cost,
all sorts of fun stuff.
If something happens to him, he can tap into those living benefits if he gets cancer or something. It seems like everyone I know lately is getting cancer of something sort.
Yeah.
And
living in the Central Valley is a cancer.
Yeah. I'm like, man, what
Our
is...
DNA changes just by breathing.
Yeah, I'm like, what is going on this year? Like, I know 4 or 5 people this year that have been diagnosed with cancer, and some of them have to stop working, and they're like, this is going to eat me up.
Yeah.
I'm going to start tapping into my 401k, which was barely going to be there for retirement. And, and I'm thinking, my clients, they have coverage, but I'm like, if they just had like a $400,000 policy, they could have tapped into some of those living benefits. They could have had 50 grand in hand and just lived on that for a year or whatnot, and I'm just like, not enough people know that you can use life insurance while you're alive.
Exactly.
And that's powerful. I mean, I've only given one living benefit check away. It was about 80 grand. And I was like, wow, the company we called.
It made it work, huh?
Yeah, I was like, man, does this really work? Because, you don't have anyone really. Sometimes you go years and you're like, do these living benefits really work? And then someone gets diagnosed with a heart attack and they're not working now, and their policy says, they can tap into 15% because, the stents and everything, that's pretty severe. They have up to this much they can pull out of their death benefit.
Right.
And they're like, I'm not working. I own my own business. And I say, well, you can pull up to 80 grand out of your life insurance. And then when you get the check, you're like, whoa, this is real.
Yeah.
They just gave you $80,000.
And it's usually tax-free.
Yeah, tax-free. Yeah. Don't have to pay it back. I was like, they just gave you 80 grand. And that's not you get the whole 80 grand.
Yeah.
They're not going to take 50% of it.
Don't ask any questions.
Tax-free.
There you go.
And I was like, here you go. You can live on this for the next year until you recover, and then not stress on your business and paying bills and having payroll or whatever it might be. So
no, that's a huge deal.
Yeah.
You can't, I mean, the benefits are exponential.
Yeah.
And if you set it up even to where, for some of the younger clients, you can set it up to where it could become their pension.
Yeah.
Where it's, we know pretty much anybody age 30 and below is probably not going to get Social Security.
I'm not depending on it at all.
Almost guaranteed.
I'm not even, I'm putting money into my own things, mutual funds, getting things paid off, maxing out my life insurance. My kids dumping some 5-6 grand into their IRA accounts every year. I'm like, I'm not even relying on Social Security. I'm just pretending it's not there. I'm totally on my own out here.
Yep, 100%.
No one's coming to save me, even if I call Daddy. No one's coming to save me.
No one's coming. Daddy don't got no money either.
You don't got any money in here. I could give you this money, but you're going to need it later. I'm going to deny you access.
Exactly.
Yeah.
So that you create a pension for them. That extra money that goes in there, the life insurance, that's the craziest thing. I get 0 phone calls from people about how bad life insurance is doing.
Yeah.
I get a lot of phone calls with how bad the market is doing.
Yeah.
So
no one ever calls and says, I don't know if I want my life insurance anymore.
I can't believe I made more money this year.
Yeah.
Gosh darn.
Yeah. Yeah.
So that's where the life insurance has a 0 floor. So why not take advantage of creating something with a 0 floor and giving yourself something for an opportunity to take that money back.
Yeah.
On a periodic basis and still have coverage.
Mm-hmm.
So that's I kind of line up a lot of my younger clients into that with the understanding that, hey, no one's going to be here to save you.
Yeah.
You got to save yourself. The only way you're going to save yourself is to create that pensionable item through these particular investment strategies.
Yeah. Yeah, because think about how much you need to live on a month right now. Yeah, those things will go down in the future a little bit. Maybe you shouldn't have a mortgage, hopefully by then.
Yeah.
But you might buy a new car. You might have some health conditions. You might have to help a family member or a kid. And so it's like, now cut your income by half and think, nobody's coming to save me. I need to make this money last.
Yes.
Whether it's life insurance, annuities, mutual funds, or, tapping into that Roth, you need to just be scattering money everywhere.
Everywhere.
Packing a little parachute, little by little.
Bury it in the can outside.
You're like kind of like stitching a parachute together right now.
Yeah.
And hopefully by the time you're 60, you're like, okay, my parachute is built. Now I can sail and not have to, worry about, oh my gosh, I'm running out of money.
Plummet to the ground. And
no,
it's important to save. No matter what, you got to do something in the savings world.
Yeah.
And I think there's a lot of pressure for people just to survive. And if you can, and recognizing the difference between needs and wants, helps people a lot. You know, and you can be like, do I really want this or do I really need that?
Well, not just save, like, because I always tell people, to save money, but also not just keep it all in your bank.
Right.
Save it in the right areas.
Exactly.
I don't have, most of my money is not sitting in my bank savings account.
The bank's not your friend.
Yeah. So when you say save, you're talking about saving in the correct areas where you're getting the interest, you're getting the tax-free, you're getting the living benefits. You're making yourself worth a lot more dead than alive to your family, or in retirement. So don't just leave it savings. Don't just save it in a savings account at the bank, but save in areas where the money's actually going to be working for you.
Precisely.
Yeah.
Because the banks aren't your friend. Chances are, they call it a run on the bank because people don't trust the banks, but people leave all their money in the banks. Nobody runs to the life policies. Nobody runs to, mutual funds, etc. They all put a run on the bank because they want their money now. Well, the bank doesn't want you to get your money. It's a liability.
If I don't have a certain amount in my business savings account, I actually get a fee.
Right.
I was like, you guys aren't my friends.
They're not your friends.
What do you mean I get a fee? All my money's with you. What are you doing?
Exactly. What are you doing to me?
What are these late fees? And you're only giving me a 0.5%, back on that dime. But
right.
It's crazy. If you're not earning 4 to 6, 7%. So JP, where can we find you if people want to contact you? You're not in the Valley. You're in.
I'm here on Shaw Avenue, actually, here in Fresno.
Got it.
But I work pretty much nationally.
Got it.
So I'm all over the place.
All right.
The best way to get a hold of me is to look at my website, jpadvising.biz.
Okay. I'll put that link down below.
Okay. I'm also available on Instagram for connecting that way. But ideally, primarily a referral-only business where all of my clients will know someone that can utilize my services well, and I'll work directly with them. I don't typically advertise very often.
Got it.
I work very closely with every client that comes in. And I think a lot of clients, when they come in and they get the information, they always walk out going, I didn't think I had this much. It's having to go through all the processing that I do and whatnot, and I think to some degree as a result that may deter a lot of people from actually doing something because they've learned so much about what has happened and what needs to happen that it becomes overwhelming. So I have to very, very much pinpoint, we're going to do this step and then this step and then this step. Because we just we can do it all, but most people can't handle it all. We're going to do it step by step.
So you need the clients that are going to commit and do it correctly.
I have a very committed client base.
Got it.
And that could be the reason why, I've been successful for 25 years. I have clients that have been with me for 20 years.
A lot of information. And some people are like, you know what, I just don't want to do all this. I don't want to waste your time.
Some of my clients even say, you're the longest relationship I've ever had. I'm like, well, great.
Well, if you find those people that do want to do it correctly and they want to structure things correctly and they're not afraid of a little paperwork and learning some new things, those are your best clients because you're going to save them a ton of money and say at the same time, you need life insurance, you need this, you need to, you can put your kids on payroll, well, that's another step. Some people are going, how do I do it?
How do I do it?
Let's do it. So that's a great resource to have.
Exactly.
So,
but I'm happy to accept anybody who's looking to create something different for their lives. And really that's everybody. If you have the capacity to save, let's come on in and let me help you. And that's my best pitch.
Got it. All right, JP, thanks for coming on, man. This is fun. We'll probably do it again. I'm probably going to get a lot of questions out of this.
Sure.
So we might have to do this again in a month and then hit those questions. And they might be crazy questions. They might just be obvious ones. I mean, I know a lot about finance and I'm still learning things all the time. And I'm like, I didn't know you could do that.
Boy, me too.
How do you set that up?
Right. Exactly. Well, you got to keep learning. I even said to myself, the day I become complacent is the day that I need to retire. Because things constantly are changing. Products keep getting better. everything there, things just improve.
Yep.
Whether you like it or you don't like it, there's improvements there. And so how do we manage those improvements to get people to help themselves the most?
And how do we have access to it? How do I do it? There's all these great ideas, but you have to execute. So,
you're helping with the podcast.
Yeah.
So, big time, David.
I get these questions all the time. I have new business owners, people that leave companies and they want to be an entrepreneur and they blow up quickly and they're like, I'm going to owe a lot of money, I think. What do I do? And I say, you need to divide this money out, have the savings, hire your family, hire your wife. There's all these things you can do. Buy a big dog, whatever it might be.
Exactly.
So there's just all these things, but it's like, well, how do I do it? Everything sounds easy when you watch a YouTube and you listen to these guys say, well, I do this and I do that. Show me how. Where do I sign? How do I do this correctly?
Right.
So, so this was fun.
Thank you for the opportunity to come in.
Yeah, definitely. No, this will be a good one, and we're probably going to get a lot of questions, so maybe we'll have you back pretty soon.
Sounds good.
And just go from there. And I'm going to put all of JP's links down below. That way you can get a hold of them, and we'll see you guys on the next one. All right, man. I'll let you get out of here.
Cool. Thank you.
Picking your brain.
Yeah, that was awesome.
Yeah.